Good afternoon. This is Chris Brecher with the Chart Patterns Mastery / Simpler Trading free video for January 14th, 2025. What's this about? Well, it's about a lot of things started to fill their election euphoria gap, like we talked about. The problem is a number of other things, but it doesn't mean anything this second. So I'll show you what we're talking about. Number one, the S&P on the right, as you see, is up here in relation to its 200. It did fill that election gap. But on the other hand, the rut, so we'll take the non-24 hour, got decisively below its election gap. Now, just because one index got under it doesn't mean a hill of beans. But you had a number of other indexes get way under it. Whether it was the transports, we got way under it, or the DIA, or the Russell, or the XLU. But the difference is these have gone to the 200, number of them, while the S&P hasn't. So you might say, well, the S&P doesn't have to go to it. And you're right, it doesn't have to. Doesn't have to. But at the minimum, a lot of times it goes to where the other indexes are temporarily, which would be November 1st levels. That would put you down to here. Now, I'm not saying it's doing that yet, and I'll show you some of the reasons why. Eventually, I think it goes down to the 200. Now, why would I say it's going down to the 200? Eventually, not now. Because usually, when you go through a lot of historical data, when most of the other indexes, if as a group, let's say DIA, Dow Jones Industrials, Dow Jones Transports, the Russell and the utilities, when they go to the 200, usually the S&P and the NASDAQ eventually go there. So you could go back on the left and put the NASDAQ. And you can go back here, and I'm going to make it nice and big for you. And you're going to see some of these other things. We're going to take 2021 on the left and 2020. Do you see on how the NASDAQ didn't go to the 200? It had a strong uptrend, don't get me wrong, but it didn't go to the 200. Well, the Russell on the right didn't come close to the 200 in 2021. In fact, it exploded. So the probability of this going to the 200 went down dramatically. On the other hand, as you see, the Russell on the right on March 19th, and in this area at the end of February on the right, plummeted under the 200. And when did on the left it get under the 200? In March. So it lagged by about a month. So just keep in mind when a lot of indexes have done that, it gets dangerous. That's one side of the equation. Let me show you the other one. So I'm talking about eventually. So keep in mind eventually. Now, I know I've showed, and this has been a big hit. I've been showing what happened in 1980 with the election euphoria gap and filling the gap, which it did. The reason I'm bringing that up, that was the old Reaganomics where everybody thinks that's pro-business. On the other hand, yields were still going straight up, and that's why you had an 18-month bear market. But I want to show you what happens a lot in Republican administrations. Remember, theoretically, Republicans are more pro-business. You can take that any way you want, but it's the perception. And you're going to see that no matter how bad the markets looked, after the election euphoria gap, they had an explosive rally into the inauguration. That happens a lot with a Republican election win. So this could definitely happen. You could definitely overshoot, but look what it eventually did. That just took months. So just keep that in mind in there. That's what we're going to be watching the next couple of days. I know the CPI comes out tomorrow. Just keep in mind another thing that's important. Number one, definitely I think eventually this goes to this area. Definitely I think. That really helps you, doesn't it? But eventually goes to here unless you get the transports and all of them just have an absolute spectacular rally up to here. Then it's less likely to work. Just keep that in mind. That's number one. Number two, the way I look at it is you have the CPI tomorrow. The bonds have already factored in the DJCI rally. That's a Dow Jones Commodity Index. So when you go over here and you look at the Dow Jones Commodity Index, which has had a massive rally, That hurts bonds. Bonds do not like inflation, especially the 30-year bond. So when you had the bonds do this, and you had the bonds go straight down, just keep in mind of what we look at in here is these have already factored in this rally. Keep in mind that the CPI is a month look back, so it's probably going to be hotter than expected. But on the other hand, the bonds have already factored that in. So I think it's going to be a non-event tomorrow. So I think volatile will just get sucked out of the market. That's what I think. So we'll see tomorrow. You got a lot of bank earnings coming out, and the banks, even with the S&P doing nothing, filling the election gap, you've had the JP Morgan go straight up. So it's real possible the bar's a little high and JP Morgan's going to sell off on good earnings. And that will keep the ES from having a massive rally. So let's just see. Have a great night. Talk to you later. Good afternoon, everyone. This is Chris Brecher, and I'm Senior Managing Director of Stocks at Simpler Trading. Thanks so much for watching this video. If you like our content, please leave us a like and a comment down below. Also, be sure to subscribe to our channel and click the bell notification icon so you never miss any of our great new content coming out. Good trading, and we'll see you at the next video. Take care.